Hey everyone, welcome back. We're diving into some potential stock market trends for 2025. We've got our eyes on a couple of stock split stocks that have been making some noise lately. This deep dive is based on a recent article from the Motley Fool. Now, they start by pointing out the S&P 500's incredible run, like a 24% gain in 2023 and another 23% in 2024. Those are some serious gains. But what's really intriguing is this historical pattern. After 2 years of consecutive gains over 20%, the S&P 500 tends to rise by an average of 12% the following year. So history seems to be on the side of continued growth. And on top of that, we've seen a resurgence in stock splits, which often follows strong company performance.
That's right. And it's important to remember that the S&P 500 is like a benchmark, a snapshot of the overall health of the U.S. stock market. So those gains, while exciting, might usually make you brace for a downturn, a correction to balance things out. But that historical data adds a fascinating wrinkle, doesn't it?
It really does. It makes you wonder what's fueling this continued growth, or whether it can really last. And speaking of growth, let's talk about those stock splits. For everyone who's not quite sure, a stock split is basically when a company divides its existing shares into multiple shares. The total value stays the same, but the price per share goes down. It's a way to make the stock more accessible, and it's often seen as a sign of confidence from the company. Now, the article highlights two companies that have recently split their stocks: Arista Networks, ANET, and Palo Alto Networks.
Yes, let's start with Arista Networks. They're in a very interesting space right now, developing high-speed network switches that are essential for data centers and playing a critical role in the booming world of artificial intelligence.
Right. Their technology is designed to handle the massive amounts of data that AI applications need, and they've seen incredible growth, 66% in the past year alone, and a mind-blowing 2,880% over the past decade. That kind of growth is what led them to do a 4-for-1 stock split.
And if you look at their recent performance, it's easy to see why they're attracting so much attention. In the third quarter of this year alone, their revenue jumped 20% year over year, exceeding expectations. And get this, they announced earnings per share of $2.33, a 35% increase. So they're clearly on a roll.
Wow, those are impressive numbers. But for those of us who like to crunch the numbers, what's their valuation looking like?
Well, their price-to-earnings ratio, or PE ratio, is currently around 56. Now, on the surface, that might seem a bit high, but with companies experiencing rapid growth like Arista, the PE ratio is actually a more relevant metric because it takes that growth rate into account.
Okay, so walk us through this. What's the difference between those ratios, and what does it mean for a potential investor?
Sure, the PE ratio is basically the company's stock price divided by its earnings per share. It gives you an idea of how much investors are willing to pay for each dollar of earnings. Now, the PE ratio takes it a step further by dividing the PE ratio by the company's earnings growth rate. What's interesting about Arista is that its PE ratio comes in at 0.95.
A peak ratio of 0.95. What did that tell us about their potential? I know you mentioned it should factor in their growth, but how should someone interpret that number?
Well, traditionally, a PG ratio below 1 suggests that the market might not be fully pricing in the company's future growth potential. This could mean the stock is undervalued, especially for long-term investors. It's essentially saying that the stock price is relatively low compared to its earnings growth.
I see. So it's not just about how much a company is earning today, but how much it's expected to grow in the future. That makes sense.
Exactly. And now let's switch gears and look at the second company from the article, Palo Alto Networks. Their focus is on cybersecurity solutions for businesses, a sector that's becoming increasingly vital as cyber threats become more sophisticated.
Absolutely, cybersecurity is a hot topic these days, and Palo Alto Networks has been doing pretty well for themselves. Their stock has climbed an impressive 813% over the past decade, which led them to do a 2-for-1 stock split recently.
Right, and they made a strategic decision last year to move towards a more unified AI-powered cybersecurity platform. This move initially scared off some investors who were unsure about the change.
But it sounds like it could be a smart move in the long run, right? Especially given the rising importance of AI in just about every industry.
Exactly. It's early days, but there are signs that this strategy is starting to pay off. They're seeing larger customer transactions, which means businesses are buying into this new vision, and their annual recurring revenue is also on the rise.
So even though there was some initial hesitation, it seems like they're starting to gain traction with this AI-powered platform. What about their financials? How have they been performing in light of this strategic shift?
Well, their first quarter results for fiscal year 2025 showed a return to growth, with a 14% increase in revenue and a massive 77% surge in earnings per share. So it seems like those initial concerns might be fading as the results start to speak for themselves.
Yeah, it sounds like it. And their PE ratio, is that currently around 51?
Yes, around 51, which, Arista might seem high at first glance, but again, if you look at their PG ratio, which is only 0.15, it suggests that despite that PE, the stock could actually be significantly undervalued.
Wow, a PG ratio that low is pretty remarkable. I'm curious what could explain such a discrepancy. Is the market still hesitant about their AI strategy, or are other factors at play?
It's likely a combination of factors. Remember, any time a company makes a major shift like this, it takes time for the market to fully digest the implications and adjust its valuation accordingly. Investors might still be waiting to see more concrete evidence that this new strategy is translating into sustainable long-term growth.
That makes sense. It's like they're playing a long game, and the market is taking a wait-and-see approach. But those early signs of success are definitely promising. It makes you wonder, what's the competitive landscape like for these two companies? Are they facing any major rivals in their respective fields?
Well, both Arista and Palo Alto Networks operate in highly competitive markets. In Arista's case, their main competitors in the high-speed networking space include companies like Cisco and Juniper Networks. These are established players with a long history in the industry. Arista's advantage lies in its focus on cutting-edge technology, specifically its expertise in cloud networking and its early investments in AI-optimized solutions.
So they're going up against some giants, but they're carving out their niche by staying ahead of the curve. In terms of AI and cloud computing, that's a smart strategy. What about Palo Alto Networks? Who are they battling in the cybersecurity arena?
For Palo Alto Networks, the competition is even fiercer, with a multitude of players vying for a share of the cybersecurity market. Some of their main rivals include Fortinet, Checkpoint Software Technologies, and CrowdStrike, each with their own strengths and weaknesses. Palo Alto Networks has been differentiating itself by moving away from a traditional fragmented approach to cybersecurity and offering a more unified platform powered by AI.
So both companies are disruptors in a way, challenging the status quo and pushing the boundaries of what's possible with AI in their respective industries. But we've talked a lot about the potential of AI. Are there any risks associated with this heavy reliance on AI, especially for these two companies?
That's a crucial question. While AI offers tremendous potential, it's not without its risks. One major concern is the possibility that the technology doesn't deliver on its promises. AI is still evolving, and there's no guarantee that it will live up to the hype, especially in the long term.
That's true. And I imagine that in fast-paced fields like networking and cybersecurity, there's always the risk of disruption. What if a new competitor emerges with even more advanced AI solutions? Could that threaten the dominance of these companies?
Absolutely. That's always a possibility in any industry, but it's particularly relevant in the tech sector, where innovation is constant, and the competitive landscape can shift rapidly. For Arista, their reliance on AI-optimized networking solutions could backfire if a new technology emerges that renders their current offerings obsolete.
So while they're ahead of the game now, they need to stay agile and adaptable to maintain their competitive edge. And what about Palo Alto Networks? What are some of the potential risks they face?
Well, for Palo Alto Networks, their success hinges on the effectiveness of their AI-powered security platform. If their AI algorithms prove to be ineffective or vulnerable to exploitation by hackers, it could damage their reputation and erode customer trust.
Right, cybersecurity is all about trust. If their AI-powered defenses fail, it could have serious consequences for their customers and their business. So it seems like both companies are walking a tightrope in a way, balancing the potential rewards of AI with the inherent risks that come with it.
Exactly. It's a high-stakes game, but they both seem to be well aware of the challenges and are actively working to mitigate those risks.
And that brings us back to the importance of due diligence and research. Remember, this deep dive is for informational purposes only, and we're not giving financial advice here.
Yes, it's crucial to remember that investing always involves risk, and you should never invest in something you don't fully understand. Always do your research, consider your own financial goals and risk tolerance, and consult with a financial advisor if needed.
Absolutely. We're just here to spark your curiosity and encourage you to explore these companies further. Now, before we move on, I want to circle back to something we touched on earlier, stock splits. You mentioned that they're often seen as a positive sign, but can you explain why that is? What makes them so special?
Well, as we mentioned before, a stock split often signals that a company is confident in its future prospects. They wouldn't want to make their shares more affordable if they didn't believe the price would continue to rise over time. It's essentially a way to increase the liquidity of their stock and potentially attract more investors.
Right, and a lower price per share can make the stock more appealing to a wider range of investors, particularly individual investors who might not have had the capital to invest at the previous higher price.
Exactly, and by making their shares more accessible, companies can potentially increase demand for their stock, which could in turn drive up the price. So while a stock split doesn't change the underlying value of the company, it can be a positive psychological signal to the market.
It's like they're saying, hey, we're doing great, and we want to make it easier for everyone to join us on this journey. But of course, it's never that simple. There are always other factors to consider, as you mentioned earlier, like market conditions, industry trends, and a company's overall financial health.
Precisely. A stock split is just one piece of the puzzle. You can't rely on it as the sole indicator of a company's future performance. You have to look at the bigger picture.
Okay, so let's zoom back in on Arista Networks for a moment and their role in the AI landscape. You mentioned earlier that they've developed these custom Ethernet systems specifically for AI applications. Can you elaborate on that a bit? What makes their technology so well suited for AI?
Sure, as AI applications become more complex and data-intensive, traditional networking infrastructure just can't keep up. Arista recognized this early on and invested heavily in developing high-bandwidth, low-latency Ethernet solutions, specifically designed to handle the massive data flows required for AI training and processing.
So it's like they're building the superhighways of the AI world, enabling these powerful applications to function at their full potential.
That's a great analogy. Their technology allows for lightning-fast communication between servers, GPUs, and other components that are essential for AI workloads. This level of speed and efficiency is absolutely crucial for organizations that are serious about leveraging the power of AI to gain a competitive edge.
It's fascinating how interconnected everything is becoming, from stock splits to AI. It's all part of this rapidly evolving technological landscape that we're all trying to navigate. And Arista Networks seems to be at the forefront of this evolution, shaping the future of networking with their AI-focused solutions. But now let's switch gears back to Palo Alto Networks and their foray into AI-powered cybersecurity. You mentioned that their strategic shift initially scared off some investors. What was it about this move that caused such concern?
Well, anytime a company makes a major strategic change, there's always a level of uncertainty that comes with it. Investors tend to be cautious, especially when a company decides to move away from a proven business model and venture into uncharted territory.
In Palo Alto Networks' case, they decided to consolidate their various cybersecurity modules into a single unified platform. It's a bold move, but it makes sense when you think about it. Instead of having a patchwork of different security solutions, businesses could now have a more comprehensive and integrated approach to cybersecurity.
Precisely. And the integration of AI into this platform was seen as a key differentiator, allowing for more proactive and intelligent threat detection and response. However, this also meant that Palo Alto Networks was essentially asking its customers to make a significant shift in how they approach cybersecurity.
So it was a bet on the future, both for the company and its customers. And as you mentioned earlier, there were some early bumps in the road as investors grappled with the implications of this new direction.
Indeed, but the recent performance suggests that this bet might be starting to pay off. The fact that they're seeing larger customer transactions indicates that businesses are willing to embrace this new model. And the growth in their annual recurring revenue further supports the notion that this strategy is gaining traction.
It sounds like they're successfully navigating this transition and carving out a strong position in the AI-powered cybersecurity market. It's a testament to their vision and their ability to adapt to the evolving needs of their customers.
It certainly seems that way. And this brings us back to that fascinating point about AI's influence. It's not just changing how businesses operate, it's also reshaping entire industries, including the stock market itself.
Totally. I mean, think about it. AI is already being used by hedge funds and institutional investors to analyze vast amounts of data and make investment decisions. And as AI technology continues to evolve, its role in the financial markets is only going to grow.
Absolutely. And this raises an important question for our listeners. How might this increasing reliance on AI impact the way we approach investing in the future? Will it level the playing field, giving individual investors access to the same sophisticated tools as the big players? Or will it create even greater disparities?
That's a question worth pondering for sure, and it's something we'll definitely be keeping an eye on as this trend unfolds. But for now, let's bring it back to our two companies, Arista and Palo Alto Networks. We've talked about their impressive growth, their innovative use of AI, and even their potential vulnerabilities. But I think it's time to address the elephant in the room, the elephant being the should I invest question that's probably on everyone's mind.
Of course. And as always, we need to emphasize that we're not offering financial advice. This deep dive is purely for informational purposes, to give you a deeper understanding of these companies and the trends shaping their industries. Any investment decision should be based on your own thorough research, your risk tolerance, and ideally a conversation with a financial advisor.
Couldn't agree more. We're here to equip you with knowledge, not to tell you what to do with your money. But I think it's safe to say that both Arista Networks and Palo Alto Networks are fascinating companies, operating in dynamic and rapidly growing fields. They're both leveraging AI in innovative ways, and they both shown a knack for adapting to change. But they also face risks, as any company does. especially in the ever-evolving world of technology.
Exactly. The key takeaway here is that there's no easy answer. No guaranteed path to success in the stock market. It requires careful consideration, ongoing research, and a willingness to embrace the inherent uncertainty of it all.
Well said. So as we wrap up this deep dive, we want to leave you with a final thought-provoking question to ponder. We've discussed the potential of AI to transform industries and reshape the stock market. But what about the potential risks? How might the increasing focus on AI, especially in the case of these two companies, impact their long-term performance? What if new competitors emerge with even more advanced AI solutions? What if the market shifts in unexpected ways? These are all important considerations that warrant further exploration.
That's right, we've only scratched the surface here. Today's deep dive was a snapshot, a glimpse into the complex world of these two companies and the forces shaping their destinies. The future of AI and its impact on the market is a story that's still being written. And who knows, maybe you'll be one of the authors shaping that narrative.
That's the beauty of the market. It's constantly evolving, presenting new opportunities and challenges along the way. The key is to stay informed, stay curious, and never stop learning.
And on that note, we'd like to thank you for joining us on this journey of discovery. Until next time, keep exploring, keep learning, and keep diving deep.
That's all for today's deep dive. See you next time.